Good afternoon, everybody. I trust that you are well. Here with my voice comments on the latest PSG Wealth Special Report. The report is aimed at those of you that are currently feeling anxious, the uncertainty getting the better of you, just to put things in perspective. So I'm not going to read through these paragraphs. I mean, you can do so in your own time. In summary, what it says is that every 18 months or so, markets experience, pullbacks of 10% or more, and every 5 years or so, it experiences pullbacks of minus 20% or more. And that over a 60-year investment time horizon, you will in all likelihood as an investor experience minus 20% pullbacks at least 12 times. It also says that as an investor you need to expect this to happen. If we have a look at this graph, it was put together by JP Morgan Asset Management, and it is on the S&P 500 over a 40-year period. And what it shows is what is the inter-year declines, being all the red numbers, versus the calendar year returns being all the blue figures. And if you just zoom out and just have a look at all the red figures and all the blue figures, you will note that every single year there were pullbacks. Reason being, markets do not just go up in a straight line. For every transaction there needs to be conflicting views. Obviously a buyer that thinks that the stock is going up, hence they're buying, versus a seller who anticipates that the market price of the particular share will drop, hence they are selling. So yeah, this is quite normal to have pullbacks during any calendar year. And yeah, markets always basically, if you have a look at it over the short term, move up and down from a day-to-day basis. What is important to note that though is that the average of this inter-year drops is 13.8%. So on average over the last 40 years, every year the market at some stage pulled back by at least 13.8%. And what's also quite interesting is that 75% of the time, 30 out of the 40 years, it actually ended positive subsequent to the drop that it experienced. So only 10 times did the market not recover in the same calendar year. Now this is basically over like I said, a 40-year time horizon. I've got another graph for us that basically runs over a 100-year time horizon, just showing in the early 30s, 40s, what sort of crises were there, and what were the amounts that the market pulled back by. What's interesting to note though is have a look at the percentages. A minus 45, it took 2.8 years to recover, but the subsequent 4.5-year return was sitting at 142%. It then corrected again at a minus 30, experienced a positive 25% return over a 5-year period, corrected again, minus 34, and then for 11 years it went quite well, 341%, and so it goes on. So if one basically extrapolates this graph now from 2020 into the future, we are currently experiencing about a minus 25%, or the S&P 500 is experiencing a minus 25% correction. But if you have a look at this and you extrapolate it forward for another 40 to 50 years, this too shall pass. I mean, this uncertainty will end at some stage, and things will return back to normal. So if we just go back to the special report, what the PSG Wealth team has basically done is they've put the same graph together just on the JSE All Share. So you will note that 13 out of the 25 years there were losses of between 10 and 20%, and 9 out of the 25-year period there were pullbacks in excess of 25%. So if we look at 2008, most probably the biggest event that we can recall, as it was the most recent one where markets dropped, had excessive pullbacks at a minus 46%, similar to 1998 at a minus 43. you will note that in 2008 the markets actually ended on minus 26. So it did recover a bit, but it didn't end in positive territory. The following year, being 2009, experienced pullbacks of 21%, but it actually ended positive on a 29% return for that calendar year. So I want to show you another graph which I think ties in nicely with this period, and it's basically this graph here. It's on the JSE All Share, and it is for that same 2008 period and the 2009 subsequent recovery. And this graph basically shows you the impact of this event over a 5-year term. So as you can see, if you look at this graph, a massive event there. But if we take the same event and we zoom out and plot it over a 50-year graph, which is basically over there, you will concur with me that it basically looks like a non-event. So what I'm basically saying is, if we extrapolate this now 2020 40 years further to 2060, what we're currently experiencing will also look like a non-event. This trend will basically continue. So what is important is the long-term picture. So the figures that they're quoting here is what was the S&P 500 40 years ago and what it is currently. If you do the math from a compound interest perspective, it equates to 8.09% per annum that the S&P 500 compoundedly grew by. Just keep in mind that this is a price return index. In other words, it didn't include the actual dividends that were received over the time period, so that has to be added to the 8%. So let's call it between 10 and 11% on average is what the S&P 500 yielded over that 40-year period. US inflation sitting at between 1 and 2%. Let's call it 2%. So it basically yielded inflation plus 8 or inflation plus 9%, taking all these massive hits into account. And the same if we have a look at the JSE All Share. If we take all these pullbacks into account, it was on 4,800 points 25 years ago, currently sitting at roughly 40,000 points. That's excluding dividends. That gives you a return of between 8 and it gives you a return of 8.85% per annum. If we add dividends to that, local dividends being slightly higher, you're looking in the region of between 12 and 13% per annum, which the JSE All Share has averaged over the last 25 years. So the long-term picture is what is important. In the short term, what you need to do is take a breather, take a step back. There's nothing that you can do in the short term, so it doesn't help to worry and have sleepless nights over what is currently happening in the world with the global economy. Know that this uncertainty will come to an end. Things will be just fine in the long run. In the short term, markets will be irrational. It will take a long time to process the positives. What is currently happening is that the whole financial market is receiving the same data at exactly the same time, and that's what makes the market very irrational or volatile from a day-to-day perspective. As I've mentioned to all of you when we met, volatility creates opportunities, so it's not necessarily a bad thing. The underlying fund managers that is managing the funds, or the portfolio managers that are managing the actual share portfolios, will exploit these opportunities over the next couple of days, weeks, months. Nobody knows exactly when this will come to an end. But yeah, if you have any concerns, please do not hesitate to contact me. I'm happy to discuss it in greater detail, your portfolio, as well as the impact that is currently taking place, what impact that will have on your portfolio. But yeah, have a good weekend. Keep well. Cheers. Bye.